Hey guys, Steven here, aka the Boiler Master. I'm drinking some coffee and doing more DD. You guys know I ignore the hype and dig into the financials because I'm a numbers and charts guy, not a storyteller. So I was asked to put together a DD starter pack for new investors on IQST. Now, you guys know I've researched IQST a lot, but it only makes sense to start off exactly the same way I would start in any other companies and try to be as unbiased as possible, just following the numbers as a new investor would. But I'm not a financial advisor though, so consider this video for entertainment purposes only. Alright, let's see where the financials are and get into the filings. But first, take a quick look at the stock chart. So the 1 year chart has IQST up 196%. That's pretty wild. Doesn't look like a straight shot up though, and pretty steady uptrend. It shows the market cap is only 53 million right now. So let's see if the financials justify this increase or not, and that $53 million valuation. Now, IQST is an OTC stock, so first place we got to go is OTCmarkets.com. Here we can see they are OTCQX. Now, that's good to see. The OTC market has three tiers. That's OTC Pink, OTCQB, and OTCQX. So QX is the highest tier with the most strict requirements. They actually have to be compliant and report their financials. Lower tiers, especially pink sheets, don't require much, so companies listed there don't have to report anything, really. I stay away from pink sheets because honestly, you never know what the company isn't telling you. But IQST is QX, so that's good. We should find everything we need in the filings just like we would with like a NASDAQ listed company. So first thing, we always like to look at their net income and see what kind of profits they have. It shows they lost about 200 grand last year, which was an improvement over losing about 6 million the year before. So not quite profitable last year, but certainly heading in that direction and looks to be operating around break even now. So dilution shouldn't be too bad, and we'll get to that point. Next, I always take a look at the revenue. Looks like they did about 145 million in sales last year, up from 93 million the year before. In fact, it looks pretty consistent. This is a pretty solid uptrend for sales every year, so looking good on revenue. So last year they basically got to break even while increasing sales from 93 million to 145 million. It's probably responsible for the share price rise. Getting to break even's good because that would mean they won't have to rely on dilution in the future. So we need to take a look at their cash position to really know if they're going to need to dilute this year. Then we'll take a look at dilution and where they're heading there. So if we pull up the annual report, 10K filing, we can see the first quarter report, but I always start with the year-over-year data first when I'm looking at a company for the first time, just to see how they're doing on an annual basis. So the cash position at the end of the year was about 1.4 million. That seems healthy since they only lost about 200,000 last year, so they should be able to cover operations without any dilution this year if the net income trends continue. There's a lot more on this page that includes all their assets, and that went up significantly year over year from about 13 million to 22 million, which looks really good. Might get into that, but we have to look at dilution first. So last year it looks like they went from about 162 million to 172 million shares. So about a 10 million share increase, which would be about 6% increase. That's not bad. But that is 10 million shares last year when they were operating around break even. The loss was only about 200,000. So what's the deal there? Let's jump back to the stock chart. We know the share price went up 196% over the last year. So it looks like a year ago the share price was under 20 cents, like well under 20 cents at some point. So we could get deeper into the filings and find out exactly how much cash they raised from 10 million shares, but pretty easy to say with that share price around 20 cents and less that 10 mil shares only raised probably about 1.5 million in cash. They lost about 200,000 last year, and looks like they're probably raise about 1.5 million selling 10 million shares. So that seems to check out since we say they finished the year with about 1.4 million cash. So 10 million dilution, that's not a lot when we're looking at 172 million shares, but We need to see if these trends are continuing and if there's been any dilution this year when we look at the quarterly report. Before we move to the quarterly report, let's look at their sales and operating expenses for the year. Their net income improved a lot year over year by about 5 million, but they still don't show an actual profit. So let's see if we can identify why. If we pull up their statement of operations, we can see 144.5 million revenue. Cost of revenue was about 140 million, and gross profit was about 4.7 million. So that's not amazing, but year over year looks like they went from 1.8 million gross profit last year to 4.7 million this year, which is actually 2022 to 2023. So 1.8 million to 4.7 on gross profit. So that's improving. They did go from 93 million revenue to 145 million. So that's about a 55% year over year increase in sales. That's definitely good. But we are looking at slim margins. Good improvement year over year, though. So where's that money going since they showed a 200,000 loss? Looks like operating expenses were just under 5 million. They did 145 million sales, so that's like 3% of sales. That's actually not bad. 5 million for a company this size is actually pretty impressive for operating expenses. And it looks like that didn't change year over year. 2022 was 4,983,000, and 2023 was 4,987,000 in operating expenses. So that basically stayed the same while sales grew over 50%. So that's definitely good to see. Let's look into that and see how that 5 million is actually being spent and what these guys are paying themselves. So salaries were 1.56 million, which was actually down from the year before of 1.66 million. So that's extremely low salaries for a company this size. They're doing 145 million and salaries were only 1.6 million. It's pretty low. We'll look at their pay in a minute, but what else is big on the operating expenses? We've got about 1.3 million in professional fees. That would be things like paying consultants or lawyers or whatever they need that they don't have someone on staff for. And with salaries only being 1.6 million a year, I'm actually surprised they don't have higher professional fees. It's a fairly small company that obviously doesn't have a ton of people on staff. So the next biggest expenses are advertising. That was about 600,000. Technology is about 300,000, and office, facility, and other was about 300,000. So they aren't spending a ton on advertising to grow sales. That's good. 300,000 on advertising is pretty low considering they grew like 55% last year, and 300,000 on offices tells me they're pretty frugal too. This doesn't look bad at all, so let's look at their salaries. Come on down to the compensation portion. We can see the CEO paid himself 240,000 last year. It doesn't show any other forms of compensation here. That is up from about 200,000 the year prior, so he did give himself a pay raise, but 240,000 salary really is not much for a CEO of a company this size doing 145 million in sales. It's actually pretty impressive, to be honest. So it says the Treasury Secretary and Director is the next highest salary at 144,000. Then Chief Commercial Officer is only at 120,000. Well, I guess that's why operating expenses are so low. Looks like these guys are taking extremely modest salaries. I looked at the company, a different company yesterday whose financials were honestly garbage, and the CEO was paying himself $3.5 million a year. So this is really good to see. CEO only making 240,000 is a very, very modest salary in comparison to some other companies this size. So far, the annual filing is passing the smell test. Sales grew about 55%. Net income improved by about 5 million, bringing them to about break even. Dilution was only about 6% last year, so I say it's worth looking further into. We need to see how Q1 performed and see if this trend's continuing towards becoming profitable and if there's been any dilution this year and how sales are going. First, we'll switch over to the quarterly view on the net income chart. It looks like Q1 saw about a $580,000 loss, so that's not good. But it does seem to, it doesn't seem to be in line with the trend. They were doing pretty consistent around break even and were profitable in Q3 and 4 by a small amount. We're going to have to look into the filing and see what happened in Q1 that changed this trend. So we'll go ahead and look at the revenue chart first, though. For Q1, looks like sales continue to improve. Q1 did 51.4 million, up from Q4, which did 47.3 million. So about a 4 million increase since Q4, and it looks to be a good steady trend up each quarter. So I'd assume sales will continue to grow this year. Now, if we jump over to the quarterly filing, see if we can find out what that loss was about and if there's been any more dilution this year. First thing we come to in the filing is their consolidated balance sheet, which shows their cash position was 2.7 million now. That's up from only 1.4 million they had at the end of the year, so that grew. We know they lost about $500,000 in Q1, so what's going on there? Let's jump to see if that's from dilution or debt, or why their cash position increased over $1 million when they showed about a $500,000 loss. So we can see here shares increased from about 72 million at the end of the year to 77.6 million. So about a 5 million increase in common shares. It says 150,000 issued as compensation. So that could be some kind of bonus or payment for some of the consulting and professional services fees. We could look deeper, but it's only 150,000 shares. Not really concerned there. Then it says about 1.8 million shares were issued for settlement of debt. Now, that could be good to clear up some debt, but we need to look at their debt and see where that's at, if that's out of control or not. And then we have the big one here, 3.5 million shares issued in conjunction with convertible notes. So convertible notes are basically loans which are backed by shares as collateral. So it looks like they paid off one loan and then took out another, which seems off since they're operating around break even and have plenty of cash for the year. So let's go ahead and jump down, look at their debt, and see what's going on there. Here we've got cash flow from investing and financing activities. At the bottom, from financing, we see repayment of loans, about 9,000. That's irrelevant. Then proceeds from convertible notes, 3.7 million. Then repayment of convertible notes, 190,000. Net cash from financing activities with 3.5 million raised. So that's where the extra cash in Q1 came from. They had 2.7 million at the end of Q1, and it looks like it's from a loan. So cash flow from investing activity shows a deposit for an acquisition of 1.5 million. So they put money down towards acquiring another company. 71,000 for purchase of property and equipment. That's not surprising, to be honest, because they were only spending like 300,000 a year on offices. So probably going to need to invest a bit more in the future since the company is growing. 51,000 advance of loans receivable. So that puts cash from investing activities at 1.6 million spent. That seems to check out, with their current cash position increasing by over $1 million last quarter. So we need to find out what this acquisition is. But let's look and see if they have any other debt first, because this just shows that took place in Q1. It doesn't show any other debts. So some debt isn't bad, especially if it's used for an acquisition that adds value to the company, but they were operating at a loss in previous years, so let's see what all they do owe. So here we have this section on loans payable. It actually doesn't show the new convertible note here. We'll have to find that in a minute. But otherwise, we see 103,000 owed to Martis, whatever investment firm that is. And we've got 90,000 owed to something about COVID-19. So total is about 193,000 in loans, and it says 103 is current. And the notes say it's due this year, and the 90,000 is considered long-term since it's not due until 2025, and it was actually issued in 2020 at 0% interest, so definitely a COVID loan, no big deal there. It's only 90,000. The other one for 103,000 was only at 5% interest, so not a major concern. I'm seeing 193,000 in debt, which is really nothing. Not concerned at all there. But where's that new convertible note at? So just below that is a section on the convertible notes. It shows total convertible notes as 3.5 million, which aligns with what we were seeing before. So total is about 3.7 million in debt. Let's take a quick look at what the convertible note was for, since they put deposit down on an acquisition with it. See what kind of details we can get. So we have a section here on deposit for acquisitions. It says they're buying the majority ownership of a company called QXTEL for 5 million. There was a 1.5 million deposit, which we saw, another 1.5 million cash due at closing, so that's 3 million of the money they borrowed right there. Then the remaining 2 million of the purchase price, because it was for $5 million, that will either be a promissory note, meaning they'll make payments over time, or they'll give them shares of the stock as payment. So looks like this acquisition is costing them about 5 million, and that's where the debt is coming from. I don't see any other real debt on the balance sheet to discuss, so as long as this acquisition is worth it, that won't be bad for their debt position. So let's see what the filing tells us about this acquisition. All right, we've got this section here on other expenses and net loss that discuss it. It says, we had other expenses of $396,000 for the 3 months ended March 31st, 2024, and talks about compared to last year. Then it says the other expenses in 2024 are largely due to $365,000 in interest expense associated with the financing for the acquisition of QXTEL, which allows us to drive the organic growth of the company. Okay, further down it says, we finished the 3 months ended March 31st, 2024 with a net loss of $580,000 as compared to a loss of $158,000 during the 3 months ended March 31st, 2023. The net loss of March 31st is highly impacted by the interest expense incurred in the acquisition of QXTEL. However, the increase in the company's value and the beneficial effects of this acquisition could be observed in the consolidated pro formas that were presented in conjunction with the acquisition of QXTEL. So basically, it's telling us that convertible note was to buy this new company. That's where all that debt came from, but it's about $3.5 million. So it also says QXTEL is expecting to add over $80 million in annual revenue and net income around $1 million a year. Okay, well, that's pretty good to see. So basically, it explains why Q1 had a loss that wasn't consistent with the trends. Q1 net loss was around $580,000, but the majority of it was tied to expenses for making this acquisition. So those are one-time expenses, not expenses we should see in the future quarters. It looks like the new company adds $80 million a year in sales, over $1 million in net income, so call it $20 million a year in sale, $20 million per quarter in sales, and that should push quarterly revenue up over $70 million since I did $51.4 million in Q1. And net income, acquisition will add another $250,000 per quarter. So if we ignore Q1 as a one-off because it had those expenses with the acquisition, they were just about break even, doing about 50,000 profit the prior 2 quarters. So probably about 300,000 net income going forward. So still around break even, honestly, but they should definitely be profitable with this acquisition now, since it adds like 250,000 in net income per quarter. If we just ignore Q1's one-off expenses, they haven't lost more than 250 in the previous 4 quarters. So definitely looking good for turning profitable and not relying on dilution to keep the doors open, and that is good to see. So what are we looking at on overall picture of their financials? Well, I'm seeing a good trend in their sales increasing, about 55% growth last year. Growth did continue in Q1, and that acquisition pushes them up quite a bit for this year if it adds another $80 million in sales. The net income is still slim, but looks like they'll be profitable now. So they're not relying on dilution, but they have continued to issue some shares which look to be related to funding this acquisition. It's a small amount this year. About 5 million new shares have been issued, which was about 3% increase. It's not enough to really hurt anything since the improvements in growth and net income offset it. The acquisition's definitely going to impact the financials in a good way, so I don't consider that debt to be too big of a deal. The debt position doesn't seem bad at all, mainly just the money borrowed in Q1 for the acquisition. So about 3.5 million in debt, which ain't bad for a company this size. I definitely like that they've kept their salaries low. CEO only paying himself 240,000 is pretty unusual, to be honest. And the next highest paid guy was only making 144,000. I would expect those salaries to go up over time as they turn profitable, but for now, they seem to be very realistic about things. The company wasn't making much money, so they didn't pay themselves a fortune. That's it's not like most companies I run into. Quite often, you see CEOs making millions of dollars, regardless of what the company's making or losing. Overall, I say it's a pretty healthy company. Strong growth, improving the bottom line, not relying on investors and dilution to keep the doors open anymore. And they just made a pretty significant acquisition. This one is definitely worth looking into their story. I always check the balance sheet first because the financials are most important to me because literally every company has a good story, and stories don't always work out, guys. But this company seems to be doing okay, on the right track. For a basic overview, looking at their balance sheet, I like it. So let's look at valuations real quick and see if it's worth further research, if we should actually consider investing in it. So we know the stock was already up almost 200% over the last year, but the market cap is still sitting around 53 million. Based on last year's sales of 145 million, valuations trading around a third of their annual sales. That seems pretty low, honestly, and sales this year should be a lot higher since their growth trend looks to be continuing up, and that acquisition is supposed to add another $80 million a year. But they were running around break even on net income. If they can keep that trend moving up and this acquisition helps push them into profitability, I'd say we're looking at some pretty serious growth and doing a couple hundred million in sales and profitable with only a $53 million valuation. So, based on their improving financials, the stock should definitely continue its uptrend. Let's take a look at what the professionals have to say about it. But it doesn't look like we have any analyst ratings. That's not surprising since it's an OTC company. Not a lot of analysts review companies on the OTC market, but for my personal opinion, I definitely say the company looks like a buy based on the financials alone, which for me means it's worth doing a lot more research on the company because there's a lot more to it than just the balance sheet. The annual and quarterly filings are just my first stop to weed out the garbage. But this one looks pretty good. Everything trending in the right direction, and the market cap is pretty damn low compared to their sales. Now, like I said, I've reviewed this company before. I actually know a hell of a lot about them, but I wanted to try and give an overview for anyone new and look at it for an unbiased opinion, like as unbiased as possible anyways, the way I would review any other companies. So if you look at my recent videos about like Plug Power or Innoviz Technologies, you'll see I reviewed them in the exact same way. Just start off looking at their filings, looking at the annual and quarterly, and see what their balance sheet looks like, if they're in a healthy position or not. So I'll drop those videos in the description if you want to see them. But if you guys like the overview of IQST and want to get into the research further, I've made a series of videos about the company and even met with the CEO and the CFO for an interview earlier this month. My opinion is definitely biased because I am invested in IQST and I'm holding shares long term. In fact, I've been accumulating shares since before it started that 200% uptrend over the last year, and I haven't sold any. So, like I said, just trying to bring an overview of the company the same way I review others and be as unbiased as possible. So, you guys take it for what it is. I'm not a financial advisor, just a guy that likes coffee and DD. If you guys have other stocks you'd like me to review, drop them in the comments, and I'll catch you guys in the next one.